Greetings, class, and welcome to Chapter 1 in Managerial Accounting. In this chapter, we're going to talk about cost concepts. And what we've talked about in the prologue really was about the differences between financial accounting and managerial accounting. And here, we're going to move forward a bit with that. We're going to say, managerial accounting is now concerned with identifying information, financial information that's useful to managers. So in this chapter, we're going to cover these learning objectives. Basically, what we're doing is we're identifying these cost concepts and how they're used. And we're going to talk about different ways that we're going to use them. And we're going to talk about how we would use cost concepts in manufacturing, how we're going to use product and period cost to do financial statements. How do we look at cost behavior? We're going to look at variable cost, fixed cost, and mixed cost. And then how do we use cost information to make decisions? In that case, we're looking at differential cost, sunk cost, and opportunity cost. And then we're going to identify how we prepare financial statements using a traditional and contribution format in a manufacturing company. To start with, cost classifications are highlighted here in Exhibit 1.1. This is a very good layout of basic cost classifications that we're looking at. And basically, when we're assigning cost to cost objects, that could be a good or a service, could be something we're making, or it could be something we are providing, a service of some kind. We're going to have direct costs and we're going to have indirect costs. When we're talking about in manufacturing, we're going to have direct manufacturing costs like direct labor and direct materials. We're going to have manufacturing overhead costs that we need to assign to all the products we make. We'll have non-manufacturing costs that include administrative offices and selling and so on. Financial statements, I mentioned this in the learning objective. We're going to look at product and period cost. And then when we look at product or cost behavior and analyze it, costs are going to be in one of these three categories. They're either going to be variable or fixed, and then sometimes they're going to be mixed. Then for our decision making, we'll look at differential cost between alternatives, a sunk cost that we should ignore. An opportunity cost is something that we give up, a benefit we give up or surrender to pursue a project. Now, when we start out, we're looking at direct and indirect cost, and a direct cost is very simply something that we can easily trace to a particular cost object or a product or service, and we know that there is a direct relationship between that cost and the cost of the service we're providing. So if we identify something that goes into a particular service as a direct cost, that means we're not going to be able to provide that without that cost. An indirect cost is something that we might not be able to trace easily. So if you're looking at production of particular products, it's easy to say, okay, in this particular case, we know that in the example I give of the Campbell's Soup Factory, we know that the cost of the materials or the cost of the labor that's doing these particular steps are directly involved, but indirect costs will be other costs that we can't trace. So, for example, if we talk about the factory manager's salary, that's a common cost for producing all of the products in the factory. That's going to be an indirect cost. So it's common to a number of different cost objects or products, but it's not directly traceable. Now, if we look at manufacturing companies, we're looking at direct materials, things that go into this particular product. For when I was right after I graduated high school, I worked for a time for an epoxy factory in Indianapolis, and the direct materials that they had that went into the products were many of the chemicals they used to make epoxy, and those were the raw materials. So we would order lots and lots of silicon, and we would use silicon in the products. We would also use different kinds of fillers that went into the basic epoxy resin. For example, in one case, they used a wood-like substance to simulate a mahogany finish when they produced the epoxy resin. And another one, they filled with aluminum filling so that it looked more like an aluminum. It was specifically made to repair aluminum Quonset huts, or it was for that purpose. But when we look at those direct raw materials, that will include all the things that go into that particular product. Direct materials include all the parts that go into a product if we're making something else. If we're manufacturing something like a car, for example, all those pieces that go into it that we're using to put that together, that's going to be a direct material. Direct labor would be anybody who's actually working on the units of production. So, for example, like I went back to that factory, the epoxy factory. Part of my work at that factory was to actually package epoxy resin, and basically we sold it in very large quantities. So my job would be to actually get the resin when it was still very warm and put it into containers when it was easy, when you could work with it easily. So my labor was direct labor because I was packaging the material after it was manufactured. We have direct costs that direct labor is sometimes called touch labor because if you're going to be direct labor, you're actually handling the product itself. And then the raw materials or the direct materials are going to be the other direct cost. Both of those fall in the category of prime cost because that's what it takes to actually produce the product. Manufacturing overhead is a manufacturing cost. This is not a cost of administration, but this is a cost directly associated with the manufacturing itself. Perhaps it's other equipment in the factory that does not get used specifically for one product. It may be used for many products. There may be some other kinds of materials that are used to clean the factory floor and things like that, to prepare the machinery, to maintain it, and so on. That kind of cost is manufacturing overhead. Those indirect costs are not easily traced to any particular product, but all of them are necessary in order to operate the factory in a way that will produce those products. When we talk about conversion cost, the conversion cost is whatever it costs to actually make the product. So we cannot make the product without factory overhead or manufacturing overhead. So we take both the direct labor, direct material, and manufacturing overhead. So we're actually, not direct material, direct labor and the overhead. That's what it takes to convert the materials into the finished product. When we look at non-manufacturing costs, these are the costs that are really associated with the office personnel who really are not going to be working in the factory itself. These folks may be marketing, they may be accounting, they may be other what we would call front office or executive positions. Anyway, these are going to be costs associated with general management. And then when we're classifying costs, when we're doing a financial statement, many times we're going to look at how a cost is classified for a financial statement in order to determine how it should be treated. So, for example, a product cost is a cost involving what it takes to acquire or make a product. So if we're thinking about product costs, we're thinking about any cost that goes into actually obtaining a product that would include shipping the product to us, perhaps getting the product ready to sell. But those costs would be product costs. We could include those in the actual inventory itself. So any of those costs that include the cost of getting the product to the factory and prepared for selling would be inventoriable cost. When we talk about when we talk about period costs, we're talking about something that's not necessarily a part of the product. By the way, product costs or in a manufacturing environment are going to flow through 3 inventory accounts that we have. So when we're manufacturing, we have raw materials. In that epoxy factory, for example, when we got raw materials in, we would get bags of silicon, and we would have other chemicals in drums around the factory. And so whatever combination of materials we needed for a specific epoxy resin, we would pull out of the raw materials and begin the work in process of converting that into a finished good. So work in process is work that's on the assembly line, or perhaps even in the process of being converted into a finished product we can sell. And that may be at different stages. And then the finished goods are anything that we can place basically when we move it from the manufacturing floor to an inventory of some kind. That's a finished good because we're preparing to sell that. Period costs are not product costs. So if we're talking about a period cost, we're talking about something that would fit into administrative and general expenses, sales commissions, for example. So period costs are something that's not going to be associated with a product, although it's an indirect cost, but a period cost is actually going to be something that's going to happen in a specific period and not be attachable into an inventory. So we don't have any connection between it and inventory. So here's how the costs that are classified as product costs will show up on the balance sheet. In a manufacturing environment, we're going to have raw materials that will go into raw materials inventory. We're going to have, these are product costs. We have direct labor and manufacturing overhead that go into work in process. And then when those goods are completed and we have finished goods, they're going to come out basically and be in the cost of goods sold. The finished goods will be included in cost of goods sold. And then the period costs are going to be outside of that. They're included, they're part of the cost of our operation, but they're going to happen outside of the manufacturing process. So be the selling and administrative expenses would be period costs. Now, when we talk about cost behavior, we're talking about different ways that costs change over time or don't change. Variable costs are costs that are going to vary in direct proportion to the changes in the activity. So my thinking here is the more we manufacture, it's very likely we're going to use more in utilities like electricity or other. So if we increase our activity in manufacturing, we're going to increase our use of electricity resources. That would be a variable cost. And it changes. It's variable in relationship to something else. So here, this example that they provide is a small company providing whitewater rafting excursions. And they're going to provide the equipment, guides, and meals to the folks that are going on these trips. So depending on the number of guests, the cost of the meal is going to be there. It's going to be the same, but the total cost of meals will vary depending on how many guests they have. So if they have 250, they have this cost. If they have 1,000, they're going to have this cost. So variable costs are going to change. And if you graph it, a variable cost will look like this on a graph. So the more you sell, the more you have in cost. Now, over here, this is an example of a fixed cost. So if you were running a business and you increased production, the cost of your building rental will not change if you're renting a building, for example. So you rent that building space for a certain amount of money, no matter how much you actually produce. A fixed cost, they show that here. So this is the same company. They're renting a space in a building. They have a number of guests that come through. What will change in this is not necessarily the cost itself, but the more guests they serve, the less the cost is per guest. So if you increase the number of sales that you have, or the number of guests coming through a particular place, your fixed cost per guest will drop. And that's simply what that is they're actually, the more guests you have, the more overhead that they're picking up or that they're actually supporting. So in other words, this overhead cost per guest will drop. So when we have fixed costs, we're either committed or discretionary. When we have committed ones, we have a specific commitment to those fixed costs that will not change based on what our plans are. But discretionary fixed costs are usually going to arise from annual decisions about fixed cost items. So this would include advertising, research, public relation, and so on. Now, we have fixed costs and a relevant range here. What we're saying is that you have a range of activity within which this fixed cost is going to happen. So this is almost like a mixed cost, but basically what this is going to be is you're going to have a certain amount of fixed cost at a certain activity range. So in this example, they're showing a certain number of tests, and I believe this is from the Mayo Clinic. They rent a machine that samples, and so if you run 3,000 tests in a month, or 3,000 tests, the cost is going to be this cost. But in the range from 0 to 3,000 tests. But when you cross the 3,000 tests, you're going to have an increase in the cost, and that will hold true for a range between 3,000 and 6,000 tests. Then the next break, or the next step that you're going to see, is going to be a jump in the cost when you hit 6,000, go above 6,000, you're going to see a $60,000 cost. These are basically step costs, or what we used to call step costs, but these are going to change with certain levels of activity. So in this exhibit, you see these concepts related to variable and fixed cost behavior. These are important concepts. We want to remember these. We want to think about these. If we think in total, variable costs are going to increase or decrease in total related to a specific activity level. Per unit, variable costs will be constant. So we're going to say however many of these we want to make, we know that it's going to take X amount of cost per unit to make it, and that will increase in total with the number of units we make. With fixed costs, the total cost in the whole will not change. It'll be the same regardless of the activity that we're doing. But per unit basis, the fixed cost per unit will decrease with an increase in activity. So, and by the way, the cost per unit will increase if the activity level decreases. So we want to make that distinction between variable and fixed costs. A mixed cost will have both variable and fixed cost elements in it. Typically what you're going to see here is there's going to be a base level. You're going to have a certain minimal amount. We're going to have a specific amount of cost that we're going to pay regardless of the activity, and then it will increase after we pay that initial amount. It'll increase with increased activities. So they show this mixed cost here for the Nooksack expedition example they used earlier. These are the mixed cost is called fees paid to the state. So in this case, for them to be able to conduct these tours, they have a licensing fee of $25,000 a year plus an additional $3 per rafting party, and they pay that to the state, the Department of Natural Resources. So what that means is before you even start, you have to have this $25,000 expense. That part is fixed. But the part that is variable, and this means that it's a mixed cost, is the fee paid per rafting party. So you have a $3 fee per rafting party. So if you have more rafting parties, you're going to have a higher level. So you have the variable cost element here, but the fixed cost element here. So you have the beginning or base, and then the variable that's added on top of that. And by the way, those costs are not uncommon. They do happen in different ways for different companies. But this calculation is how you are going to calculate the total fixed or mixed cost. So you're going to add the fixed cost, the base level here, letter A, and you're going to add that to the variable cost per unit of activity times the level of activity. So this is a basic slope formula, but this is going to work for what we're talking about here in mixed cost. Now, if we look at these this terminology that we're looking at, we're going to talk about what product cost is, and this is going to be through formula. So we're going to think about product cost as direct materials plus direct labor plus manufacturing overhead. We're going to add all those up to get product cost. Period costs are going to be these two overhead costs, and then conversion cost is the direct labor plus manufacturing overhead. Prime cost is direct materials and direct labor. Variable manufacturing cost is going to be the direct materials, direct labor plus variable manufacturing overhead. And when we talk about variable manufacturing overhead, a cost like electricity would be a variable manufacturing overhead cost. And then we have a total fixed cost, which is going to be the fixed manufacturing overhead plus fixed selling expense plus fixed administration expense. So with a fixed cost in manufacturing, you may have rental for the manufacturing space. That would be fixed. And that would be part of what we're talking about here. When we talk about decision making, we're talking about differential analysis, and we're going to look at things in different scenarios. So we have a differential revenue, a differential cost, and we could also call that incremental cost, because what we're going to do is we're going to look at it in different scenarios. So for example, we're going to analyze a retailer distribution here and a sales representative here. These are two different methods of distribution. So in this case, what they're looking at is they're looking at using two different distribution chains. They're going to use retailer distribution the way they're doing it now, which means they're not going to pay any sales commissions, but they are going to have these other costs like the warehouse, depreciation, other expenses, advertising, and those costs associated with it. Now notice they're looking at in the present situation with a retailer distribution, they're estimating $700,000 in sales, but they anticipate if they bring in sales representatives that will increase by $100,000. So what they're going to do is they're going to look at the difference in these costs, and so the differential revenue is the difference between these two revenues. You have a $100,000 increase. Cost of goods sold, with higher level of sales, you're going to have higher cost of goods sold. But look at this, when they move to sales reps, they're going to be able to cut $35,000 off in advertising. However, they're going to pick up $40,000 in additional commissions. The other disadvantage here is going to be they're going to increase expenses for warehousing. So you notice that they increase warehousing costs by $30,000. When you get to the bottom line, though, they've increased revenue by $100,000 and costs by $85,000, and so they have a differential net operating income of $15,000. So depending on the requirements for the project or the proposal, they may be in a situation where they want to make that change in order to have that increased additional revenue. Now, when we talk about a sunk cost, and we're looking at a decision like this, a sunk cost is a cost that already was incurred, and whether we do the project or not, or the proposed change or not, we're still going to have that cost. A sunk cost cannot be changed in any way based on the decision we make. So we ignore sunk costs. On the other hand, an opportunity cost is where we're looking at the cost of something we're giving up in order to obtain something else. Well, not cost, the revenue we would normally make. So, for example, if you had floor space in a particular building and you were thinking about whether or not to use that floor space for additional manufacturing, however, if you don't use it for manufacturing, you can rent it out to another business. The rent income that you give up to convert that into manufacturing space is an opportunity cost. So you say, okay, instead of renting this out for so much per year, instead I'm going to convert that into a manufacturing space. Because I do that, I lose that revenue. Usually, every time you make a decision and you're looking at two different possibilities, there will be an opportunity cost in it somewhere. Now, we're going to look at here the format for the income statement, and we're looking at the traditional versus the contribution format. Notice or remember when we did cost of goods sold, we were looking at beginning inventory plus purchases minus ending inventory to get the actual cost of goods sold. These are product costs, and we're going to report those as they're incurred. Now, the goods, the cost in a merchandising inventory or merchandising enterprise will include cost of goods sold. So one way of looking at it is through the traditional format. When we prepared an income statement using cost of goods sold for a merchandising company, we would begin with the sales, calculate cost of goods sold, and subtract that out so that we would have a gross margin, and then we would deduct the costs of operation. So we would have selling and administration, and that would give us a net operating income. However, for some businesses to evaluate what a product contributes to the overhead, or actually let me rephrase that, to evaluate how much overhead a product will absorb, there is this idea of a contribution margin. So we're going to begin with the sales, which we started with, and we're going to list variable expenses. So we're going to deduct the cost of goods sold, but we're going to identify variable selling expense and variable administrative expense because these are directly connected to how much product we're selling. So we're going to reduce that out, and we're going to identify then the contribution margin, or what this product will contribute toward fixed overhead costs. Okay, I want to mention something here with this contribution format. When I worked at Blue Cross, we were very interested in this information. And the reason we were interested, if you are, and a lot of hospitals were as well when we did Medicare audits, the reason they're interested in this is because technically, if you are in filing the Medicare cost report that we used to audit when I was an auditor for Blue Cross, you were allowed. By the way, Medicare was a product. Well, not a product. Medicare was a service, a classification of a service that these uh, providers were giving to a class of patients. But Medicare was always intended to reimburse these providers their costs of doing business, not to provide them with a profit margin. So technically, the interest in many of these providers' eyes was not necessarily for the profit margin per se, but to identify how providing those services to these beneficiaries or these patients would help them cover some of these other overhead costs. So they would evaluate that in that way. And when I was at Blue Cross in the cost analysis area, we would do this similar evaluation when we were looking at different lines of services and products that we were providing, because we wanted to know, the executives wanted to know how much these products and services contributed to the absorption of overhead, so that we would not necessarily be, let me say it this way. Sometimes it would look like it would be good to eliminate a product, but if you eliminate the product, you also eliminate the amount of overhead it's absorbing. So you wind up in a worse position by eliminating it. And that's why a lot of executives were interested in this information. So this is this contribution format's a very good approach to use. A lot of people use it because it makes a lot of sense and it contributes to managerial information that's needed. Anyway, that's it for this video, and I look forward to seeing all of you in class.